After 60 years of slaying the markets, legendary investor Warren Buffett is finally calling it quits. He's leaving his successor with enormous shoes to fill and, more importantly, an obscenely large amount of money to invest. This cash pile is so big that some are worried it's not so much a rainy day fund as preparation for an apocalyptic market crash. So today we take a closer look at Buffett's mountain of cash and find out whether there is anything to this intrigue. My name is Guy and you're watching The Coin Bureau. At 94 years old, it wasn't earth-shaking news when Warren Buffett announced his intention to step down as CEO of Berkshire Hathaway earlier this month. You don't see too many nonagenarians leading trillion-dollar multinationals nowadays, so it was only a matter of time. The announcement did, however, draw attention to two things, namely Buffett's extraordinary investing career and the also extraordinary balance sheet that he's poised to leave behind at Berkshire Hathaway. So, firstly, his career. Warren Buffett is widely considered one of, if not the most successful investors of all time, having earned the nickname the Oracle of Omaha for his extraordinary 6-decade record of outperforming the US stock market. For context, Buffett was born in Nebraska in 1930 to a 4-term congressman and investor father, so it's not exactly a rags to riches story. Still, if there was ever someone born with a predisposition to investing in securities, well, it had to be Warren Buffett. He absorbed himself in the world of capital markets at a very early age, loitering at regional stockbrokers and visiting the New York Stock Exchange at the age of 10. He bought his first stocks at age 11, and by 21 he was employed as an investment salesman at his father's own brokerage firm. He later started his own investment partnership firm, and it was through this company that he started aggressively buying shares of the ailing textiles manufacturer Berkshire Hathaway from its CEO in the early 1960s. After gaining a controlling stake in the company, he fired the CEO, later describing the textiles business as the worst investment of his life. Buffett slowly wound down the textiles operation, replacing it with a much more successful insurance underwriting business under the same name. But above all else, Berkshire became, under Buffett's stewardship, a diversified holdings company. So, an investment vehicle for acquiring other companies and reinvesting the profits of one into another. And it's Berkshire Hathaway, the investment vehicle, that Buffett has been riding into the sunset ever since, becoming, by all accounts, the most famous and successful investor in American history. And by the way, if you think you've got what it takes to be the Warren Buffett of crypto, then allow us to help you on your journey. The Coin Bureau deals page has got sign-up bonuses of up to $100,000 and cashback deposits of up to 75% on the best crypto exchanges, as well as trading fee discounts of up to 50%. If you're planning on buying and selling crypto, these free deals can save you a lot of sats, so take advantage of them while they're still available, linked to down below. Now, to see how exceptional Buffett's investing career has been, we only need check out the Forbes Rich List. With a net worth of $154 billion at the time of making this video, Forbes has Buffett pegged as the 6th richest person on Earth. And like most of the other people near the top of Forbes' rich lists, Warren Buffett is an American tycoon and a household name around the world. But alongside the likes of Zuck, Musk, Bezos and Gates, Buffett sticks out as the only centibillionaire and only name among the world's 10 richest people whose industry is listed as finance and investing. All of his top 10 neighbors are in tech, fashion and retail, or in Elon Musk's case, automobiles and, well, much else besides. Buffett, therefore, appears to be peerless in his field. If we move down the Forbes Rich List, the next name in finance and investing is Michael Bloomberg in 14th place, but he made his fortune from the Bloomberg media business. In 23rd place, there's Binance's CZ, but now we're getting even further away from Warren Buffett territory. In 25th place, there's Jeff Yass, founder of SIG, one of Wall Street's largest and most successful stock trading firms. His company also makes its money in the stock market, albeit in a completely different way from Buffett's. The closest to a Buffett peer we can find then is Stephen Schwarzman, co-founder and CEO of private equity giant Blackstone. Sitting in 31st place, Schwarzman has a paltry net worth of $44 billion, a little more than a quarter of Buffett's $154 billion. This is why we think it's fair to say that Buffett is unrivaled in the field of investing. This is borne out not only by his net worth, but by his track record over a career spanning more than 60 years. His performance has put the rest of TradFi to shame, and he has actively shamed much of his own industry for delivering worse returns for clients than a simple stock market index after fees are accounted for. According to the Financial Times, about 2/3 of money managers underperform the S&P 500, and the cohort who outperform tends to change each year. In other words, very few professionals outperform the markets for an extended period of time. In 2007, Buffett challenged hedge funds to a 10-year competition to see whether they could generate returns in excess of the S&P 500 over a decade. Shortly after, the great financial crisis of 2008 nuked the US stock market, making Buffett look a little silly at the time. But lo and behold, at the end of the 10 years, the S&P 500 was outperforming the hedge funds, making his point loud and clear. Now, the reason I'm telling you all this is to give you a sense of Buffett's accomplishment. He absolutely trounced the S&P 500 for 60 years straight. If you had invested $100 in the S&P 500 in 1960, the returns generated since then would have turned that $100 into $39,000. Now, that's a very long time horizon, but it's still a pretty great return on your investment, right? Well, it is peanuts compared to what you would have if you'd have given that $100 to Warren Buffett in 1960, because it would now be worth $5.5 million. Buffett's ability to outperform the market year after year, not by complex financial engineering or exotic trading algorithms, but by buying stocks when they are undervalued and selling them when they are overvalued, has won him the admiration of TradFi bros the world over. The success he has enjoyed using this no-frills approach to investing has inspired generations of retail investors to emulate him. Because, unlike the mathematical models that dominate trading on Wall Street nowadays, Buffett's methods do not involve any technical wizardry that us mere mortals cannot hope to understand. But, at the same time, when we ask the question, what's his secret, the typical answer is himself. As Bloomberg put it, quote, Buffett himself was the secret sauce. And if Buffett is simply much better than everyone else at this investing game, it kind of pours cold water on the idea that anyone else can do what he has done. And this brings me to the second thing about Warren Buffett that has caught the world's attention recently, and that's what he's leaving behind at Berkshire Hathaway. When Buffett broke the news of his retirement, what he in fact announced was his successor, Berkshire Hathaway Vice Chairman Greg Abel. Buffett told the crowd of Berkshire shareholders, quote, I think the time has arrived where Greg should become the Chief Executive Officer of the company at year end. Now this apparently caught everyone in the room, including Abel himself, by surprise. The board of Berkshire Hathaway later voted unanimously to formally appoint Abel as Buffett's successor. It's clear that Buffett and the board trust that the company will be in good hands under Greg Abel. But considering everything we've just said about Warren Buffett's exceptional lifetime accomplishments, Abel is stepping into some very big shoes. We won't be too shocked if he cannot match his boss's performance in the long term. And many suspect that this is one of the reasons why Buffett has spent the last year or so stuffing Berkshire Hathaway's coffers with as much cash as physically possible, to give his successor Abel the best possible start as the new CEO of a company in good financial health. Good financial health may be understating it a little though. At the end of Q1, Berkshire Hathaway was sitting on a $347 billion mountain of cash. Yeah, we're not talking about dubious unrealized P&L screenshots here. That's $347 billion in realized gains, held in USD and US Treasuries. Berkshire's cash pile is now bigger than the market capitalization of all but around the 25 largest companies in the S&P 500. It's more than the cash reserves of Apple, Microsoft, Alphabet, Amazon, and Nvidia Corp combined. And National Treasury data cited by Investopedia and Wikipedia tells us that it's also bigger than the foreign exchange reserves of, for example, the United Kingdom, Germany, and, let's see here, the United States. And yes, you are hearing that correctly. The mind absolutely boggles. So, as the incoming CEO, Greg Abel will be inheriting a company whose treasury looks like that of a wealthy nation-state. Now, Buffett has denied that Berkshire has been stockpiling cash specifically to give Abel a flying start. But, intentional or not, Abel couldn't really be beginning his tenure as CEO under better circumstances. Not everyone agrees that it's wise to store $347 billion in cash, though. Berkshire Hathaway's balance sheet has drawn the ire of Michael Saylor, who has accused Warren Buffett of destroying $3 billion a month by not investing in Bitcoin. As Saylor explained in an interview late last year, quote, "That $320 billion, that is destroying $32 billion a year. They are destroying $3 billion a month in capital because they're generating a 3% after-tax yield at best, and the cost of capital is 15%. So take 12% negative real yield." And Buffett himself might even agree with Saylor about the perils of holding too much cash. He once wrote in an article for Forbes, quote, "The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislatures. The inflation tax has a fantastic ability to simply consume capital." It was precisely this fiat currency risk that persuaded Michael Saylor to swap USD for BTC as his company's primary reserve asset back in 2020. And maybe this is why Saylor is confident that if he had an hour alone with Warren Buffett, the Oracle of Omaha would walk away hopelessly orange-pilled. Saylor may also be hopeful because Berkshire Hathaway actually has some indirect exposure to BTC already. This is through a $34 million stake in Jefferies Financial Group, a New York-based investment bank that has deemed BTC a, quote, "critical hedge against fiat debasement and inflation," and holds a position in BlackRock's iShares Bitcoin Trust ETF worth some $85 million. However, to date, Buffett has been immune to Bitcoin's charms. He's publicly described Bitcoin as, quote, "rat poison squared," and a, quote, "gambling token." Now, this is not all that surprising, as Buffett has always been drawn to boring, vanilla investments in industries like insurance, fast food, and retail banking. His risk tolerance historically ruled out even most tech stocks, which Buffett claims not to understand. So by his standards, Berkshire's investments in Apple and IBM were daring and exotic. On the other hand, when Saylor made these comments, Buffett had yet to announce that he would step down as Berkshire CEO. This has obviously now changed, so maybe Saylor could do us all a favour by sweet-talking Greg Abel instead. But for the avoidance of doubt, we don't expect Greg Abel to be any more interested in BTC than his mentor. Abel is a Buffett acolyte with a background in corporate management and accounting, who also spends his time poring over corporate balance sheets. His major contribution to Berkshire's investment and acquisition empire has been in building up its energy business. Abel's public views on Bitcoin are not known, but he is not expected to suddenly take Berkshire in a new pro-crypto direction. As for a potential encounter with Michael Saylor, Buffett and Berkshire have historically avoided the kind of leveraged financial instruments represented by Saylor's strategy. And this could put Saylor at a disadvantage as a salesman pitching Bitcoin. And most observers expect continuity at Berkshire, not least because Buffett will remain a member of the board. So, for the moment, don't expect Buffett's billions to start pouring into the crypto market. Anyway, with that out of the way, let's turn to why Berkshire, this behemoth of stock market investing, would now rather sit on $347 billion worth of cash rather than stocks. For context, Berkshire has been a net seller of stocks since 2022 and buyer of US Treasury bills. You'll recall that the Federal Reserve began hiking interest rates that year, making cash equivalent assets more attractive. But it wasn't until 2024 that Berkshire started aggressively dumping stocks, including 2/3 of its largest position, Apple, in which Buffett had invested $35 billion back in 2016. By the end of 2024, Berkshire had spent $9 billion on new stock purchases and made $143 billion by selling its existing holdings. This caused the company's pile of cash-equivalent assets to almost double in the space of a year, raising many an eyebrow in the investing world. Some have interpreted this as a warning sign and speculate that Berkshire's cash hoarding has been preparing for some black swan event, be it a US recession or some other great misfortune that Buffett is expecting. After all, Buffett is famous for pulling off big bets during once-in-a-generation market crashes, like when he bought up a sizable position in Goldman Sachs at a huge discount during the great financial crisis of 2008. Buffett is now the poster child, or poster pensioner, I suppose, for buying when the markets are fearful and selling when they are greedy. And by Buffett's good old value investing standard, the US stock market has been getting very greedy indeed, with the average price-to-earnings ratio of the S&P 500 almost doubling between late 2022 and early 2025. Last year, the ratio rose from 26 times earnings to 30 times earnings, far overshooting the historical median of 18, and screaming that the US stock market is tremendously overvalued. After a slight correction in Q1, the ratio is back down to 25 at the time of making this video, indicating that the market is still far from cheap. Historical charts of the S&P 500 index price-to-earnings ratio suggest that when it's high, a major market downturn tends to follow. For example, in 1987, 1992, 2002, and 2008. So, is Berkshire preparing for a huge market crash that the rest of us can't see coming? Well, yes and no. When stocks are deemed overpriced, it implies that future downside is likely. Anyone selling overpriced stocks is therefore de-risking, meaning that they're preparing for the likelihood of future downside. Last year, fellow billionaires like Jeff Bezos, Mark Zuckerberg, and Michael Dell also offloaded billions of dollars worth of shares in their companies, selling into greedy and euphoric markets while their stock prices were soaring. They too were, in a sense, preparing for prices to come down at some point, rather than continue going up in a straight line forever. In late 2023, Buffett even told shareholders that, quote, Berkshire can handle financial disasters of a magnitude beyond any heretofore experienced, which sounds rather ominous. But as far as we're concerned, none of this is evidence that Buffett or indeed any other billionaire has specific information about an incoming black swan event. Buffett may be an investing genius, but that's because he's prepared to take advantage of great opportunities when they present themselves, not because he knows exactly when an opportunity will present itself. What he has made very clear, though, is that there's no attractive opportunity in the US stock market today. Prices remain stubbornly high, perhaps buoyed by the relentless march of retail investors passively DCAing into the S&P 500 come rain or shine. At the annual meeting of Berkshire Hathaway shareholders this year, Buffett spoke on the cash pile and the virtue of being patient. Quote, our financial condition continues to hold a lot more cash and treasury bills than I would like, but that's simply a question of when opportunities occur. And if you get real opportunities every 5 or 6 years, you know you have to be patient. Charlie Munger always pointed out that we made most of our money on about 8 or 9 ideas over 50 years. Now, there's a lesson in this, and it's one that we all know to be true already. The best opportunities come during those rare occasions when high-quality assets are extremely undervalued. And you can outperform most other investors if you bet big on those occasions and then hodl your assets for years on end. That is Warren Buffett's life story and career in a nutshell. Most investors just find it very hard to sit on their hands long enough and have so much dry powder prepared for when such an opportunity comes, especially since nobody knows when that opportunity will come, nor what form it will take. Berkshire, on the other hand, is now armed to the teeth with dry powder, and the whole world will be watching to see how it is deployed and when under Greg Abel's new leadership. So, best make sure we're all paying attention. And while we're waiting for the next disaster that presents Berkshire with some new generational entry, why not check out the latest drama from the top of the US stock market, the possibility of the US government breaking up big tech companies. Okay, That's all from me for now, though. As always, thank you for watching, and I'll see you next time. This is Guy, over and out.